Hi, I'm Takanobu Mizuta from SPARX Asset Management in Tokyo. Here is the IEEE CIFEr 2023. Uh, I, I will give a presentation that study the title Comparing Effects of Price Limit and Circuit Breaker in Stock Exchanges by an Agent-Based Model collaborated with Isao Yagi, Konan University. If you like, you can download this presentation material from this URL. This is a table of contents of this presentation. Introduction. The prevention of rapidly and steeply falling market prices is very important to avoid financial crises. So, some stock market exchanges implement a price limit and circuit breaker. Price limit refuses orders that are priced significantly away from the current market price. Stock exchanges in Japan, South Korea, China, and other Asian countries tend to implement price limit. On the other hand, circuit breaker holds placing orders for a while when the market prices are largely varied. Stock exchanges in the USA and Europe tend to implement the circuit breakers. It is a big question which regulation, price limit or circuit breaker, best prevents rapid and large variations in price. Empirical studies cannot be conducted to isolate the direct effect of implementing a trading regulation, a price limit, and circuit breaker due to the many diverse factors affecting price formation in actual financial market. On the other hand, the actual market model can do it. Our actual market model is an agent-based model for financial market. This is a virtual and actual market built on computers. The models include agents, this is actual investors, and price mechanism, this is actual exchanges. Each agent determines an order by sub-rules, very simple rules. They determine the order. And the price mechanism, virtual exchanges gathers agents' orders and determine market prices. Uh, Agent order rules are very simple, but determine market prices is very complex because a financial market is a complex system. So, actual market model is a complete computer simulation needing no empirical data. Of course, you can use empirical data, but don't have to use empirical data. Actual market model can isolate the direct effect of implementing a trading regulation, plus direct effect of difference between the price limit and the circuit breakers. A previous study, Mizuta 2016, investigated the price limit and shows that some conditions of parameters prevent large price variations. In the previous model, the time passes only when an order is placed. But the model cannot treat time passing, just time passing, because when order is placed, time passes. When a circuit breaker is activated, time simply passes without orders being placed. So the model needs to be improved before the price limit and circuit breaker can be compared under an equal condition. So in this study, we implemented with the 2016 model and to add stop loss behavior. The stop loss behavior make to our model to compare the price limit and the circuit breaker under an equal condition, which enables the model to let time passes without placing orders. Here, I will explain our model. We employ the continuous double auction as a price mechanism. Continuous double auction very usual for actual financial market implemented in many stock exchanges. This is order books. When buy order comes, this is a shares sell, shares buy, and prices. And this 130 means when the buy order price upper than 99, they can sell. So when buy order comes at 99, transaction immediately occurred. So this is a continuous double auction. All agents use this same equation to obtain an expected return. However, because double 1, double 2, double 3 are different for each agent, expected return are different each agent. This is heterogeneous. Many order prices are diversified, although model is simple. The first term of equation represents a fundamental strategy. The second term is a technical strategy. A third term is noise. Fundamental strategy, this term is needed to prevent the price go out far away. For example, in this model, the market price started at 10,000, but when the price to the 10 or 1, the simulation is unstable, so this fundamental term is needed. On the other hand, the second term, technical term, is needed to replicate the stylized facts, for example, fat tail and volatility clustering. This is in actual financial market. The stylized fact is there are two stylized facts. These two stylized facts is strongly exist. This is a fundamental price is constant given outside. The market price blue line is a market price. Fundamental strategy: when fundamental price is larger than market price, expect positive return. In this case, because agent expect market price converge to the fundamental price, and fundamental price less than market price, vice versa. In the here case, technical strategy: when historical return is positive, here agent expect continuous positive return, so expect positive return, and the negative return case, vice versa. Erroneous orders. Within the period, erroneous order period 30,000 to 60,000 with a constant probability 50%, each order of agent is changed to sell with very low price. So increasing such erroneous sell orders is what makes market price falls. And we call dropping depth this depth. Each agent estimates a fair price and then re-estimates it when market prices fall significantly below that price. Significantly fall is occurred by erroneous order. And then agents need a long time for the re-estimation, so they place stop loss orders during the re-estimation period, which enables the model to let time passes without place orders. This is a detail. Each agent starts to place stop orders when a market price dropped to about 7,000 or 9,000. This range is different for each agent randomly. Within the stop loss period with probability, initially 35% and to 0% gradually reduce for time passing. Each order of an agent changes to sell to stop loss. Erroneous orders causes price to fall, and stop loss orders make price to continue falling after end of erroneous orders overshoot. Price limit and circuit breaker. When price limit case, any order prices under the lower limit is here. Any order prices under the lower limit price changes to exactly same lower limit price. On the other hand, circuit breaker hold placing orders and cancel for a while. On the other hand, price limit 2 under sell orders cancel. This is unrealistic, but we implement it to understand the mechanism. The reason why this is unrealistic because actual investor they know their orders cancel under the this lower limit price, so they don't order here, but they order just exactly same price, lower limit. So this is unrealistic, but to understand, we implement. For various TR and PR, we compare effects of price limit with the circuit breakers. I will show the simulation result. This is an example of time evolution of market prices with this parameter. A black line is no regulations. The prices are very sharp, make prices fell sharply and continued after the erroneous order stopped overshooting. On the other hand, with regulation, price limit or circuit breakers are very similar result. Not significantly fall. Overshoot did not occur. Falling depths for various parameters. Previous study shows that conditions that price limit prevent large falls. This equation. Yellow shadowing area indicates this is not satisfied, cannot prevent falls. So we should see only not shading area. In the case with TR greater than 10,000, right side case, the same effectiveness to prevent the falling, the result is very similar. On the other hand, left side case, less than 10,000 case, the circuit breaker was more effective because the result is less than price limit. Falling depth is less in the case with a circuit breaker. When we see the differences between price limit minus circuit breakers, it is more clarified. The circuit breaker was more effective when the left side area. This is an example of the time evolution of market prices. Left side cases are parameters. Price limit cases are more sharply falls than the circuit breaker case. On the other hand, price limit version 2 is black line, very similar, almost the same as the circuit breakers. If we see the differences between price limit 2 minus circuit breaker, price limit 2 are almost the same as the circuit breakers. A mechanism of price limit is less than effective when TR less than 10,000. The threshold TR 10,000 is exactly the same as the cancel period TC. This lower limit price is changed before the accumulated sell orders are cancelled, which leads to accumulation of more sell orders of various prices. This accumulation then acts like a wall against buy orders, which prevents rising prices. This is an example of order book, these parameters. Only the case with the price limit, many sell orders were accumulated and prevent the price from rising. On the other hand, the other cases, circuit breaker, price limit version 2, there are not so many sell orders. Finally, I conclude. In this study, we expanded on Mizuta et al. Asset market model 2016 by adding stop-loss behavior of agent and circuit breaker and then used it to investigate whether price limit or the circuit breaker is more effective to prevent falling market prices. Our findings shows that the price limit and circuit breaker are basically equally effective when the price limit range and price time range as the parameters are the same. However, price limit is less effective when TR is smaller than the cancel time range TC. In the case with the price limit, many sell orders are accumulated around the lower limit price. When TR less than TC, the lower limit price is changed before the accumulated sell orders are cancelled, which leads to accumulation of more sell orders of various prices near the lower limit price. This accumulation then acts like a wall against buy orders, which prevents the price from rising. There are many future works. In real financial market prices frequently fall for reasons other than erroneous order, and there are many cases where stock index is regulated by circuit breakers, while individual stocks are not regulated. Actually, a previous study, one 2022, indicates that if a stock index is regulated and the index crosses to the limit price of circuit breaker, some traders are in a hurry to sell, and their sell orders make the index fall, which means that sometimes circuit breaker induces a sharp fall rather than prevent it. So there are many future works. That's all. Thank you very much.